Happy Labor Day, everyone. It's Monday, September 5th, 2022. Ultimate Traders right over here. Nathan from Queens. I'm going to hit you guys all with 4 videos. I'm going to try to make them quick. The first 2, lessons learned. Third video, the market right now. The 4th video, what I plan to do this week. So I discussed that on Reddit at Ultimate Traders, that I'd like to do 3 videos, but I feel like, hey, it's better if I do 4. So this first video is about having a favorite stock, like a horse. If you plan to do trading long term, you cannot be emotional with the stock. We do not run a company. Anything could change. So we have to do the legwork and check if anything has changed quarter to quarter. Now, when I was a kid in the 90s, I had a lot of favorites and then I got killed on them. So you do not want to have favorites. I mean, you could have a stock on a watch list that you keep most of the time, but you got to see if the story has changed. A very good example of this is Upstart, UPST. Okay, in 2021, they grew in the beginning of the year as much as 200% on sales. They even had surprise profit. You know that, and actually almost every single quarter in 2021, they had growth of like between 125 and 200%, and they had a surprise profit. So when that happened, it was amazing. That's why you want to buy a stock that's growing at 200% or 100%, especially if they're making profits, and you can give a 60-80 XP ratio. Well, you have to check quarter to quarter. So 2 quarters ago, they went from 150% growth to 100% growth. And then they went to 60% growth. And then they just had downside guidance, and they're saying they're about to lose money. So obviously things have changed with the business. If you bought a stock and it doesn't have any P ratio, meaning that it's a growth company and it was growing at 100% and now it's growing at 60%, the story has changed. You do not give it the same multiple. It is not the same company. The best way I like to relate this to is sports. You know, I like baseball. You know, think of players like that you would know, Mike Trout. Mike Trout is probably the most famous baseball player right now. Still a great player, but Mike Trout is not the same player now, 2022, as he was 5-6 years ago when he was stealing a lot of bases, hitting a lot of home runs, and hitting for average. Everyone was scared. He's still a great player, but he's not the same player. So we have to weigh, we have to measure quarter to quarter. A good example of this not only is Upstart, and I'm saying this because it's very, very popular, the short thesis. Everyone wants to get rich quick. So Game, AMC, or even let's go to Bed Bath & Beyond. So Bed Bath & Beyond, when the squeeze was happening, was highest short interest, 70%. So if you're going into the trade for the short thesis, and it was working, you know, it was popular, everyone likes it, everyone was trading it, it was flying. If you're trying to do a short thesis stock, you want the short interest to be very, very high. You know, you want the cost to borrow very high as well. You want the utilization high. You want the failure to deliver, the FTD, meaning the shorts have to cover even though they don't. When slowly it dropped from 70% to 50% to now like high 30s, your short thesis ended. You don't even have to go quarter to quarter. So on short stocks, if you're trying to squeeze something, it's easier to squeeze something that's 50%. Once it's 40% or 30%, the story has changed. Get out. Get out. If you decide to hold the stock and you were going with the story and the story changed, understand that 90% of companies, that means 9 out of 10 companies, if they were crazy, crazy profitable, growing like crazy, do not come back. That doesn't mean that the company is going to stop. All right, Cisco's been around for like 35, 40 years. In the 90s, it was it was the highest market cap company in the 90s. Still a great company. It has gone nowhere, but it has not made new hires in 20 years. It just means the multiple contracts because the company has changed. So video number one, if the story changes in the company was growing fast, the company was making money, now it grows slower or doesn't make money, get off the train. If you're in a stock with a short thesis, or let's say like something that's really hot, that wasn't that short. Actually, Apron was not the same short, but it was same thing. So that was up on speculation. You're in these momentum plays. So once the short interest drops, I would say get out because those aren't real companies. And if you're in a profitable company, let's go with profitable companies. Okay, if you're in a company that was growing 50%, like let's go with Palo Alto Networks, okay? Because Palo Alto Networks is a cybersecurity play. It's hot. Everyone loves it. Analysts absolutely love it. And it's a good company. They make money. It's about 70 times earnings right now. It was 70 times earnings before, but it was growing at 50%. At 50%. So sales growth was growing at 50% and bottom line earnings was growing at 20%. Right now, it's still trading at 70 times, but growth is about 25%. And bottom line earnings is growing at about 15%. So the numbers are dropping. So if your numbers are dropping, shouldn't the multiple drop? So those are just things to look for. So this video, don't fall in love with the stock. The company has to keep executing. If the company keeps executing, then it deserves a higher P ratio. If it does not execute, that's it. Boom, cut your losses and move on.